Okay. All right. Hello, everyone, and welcome back. So today's agenda is to start talking about continuous models. We've been working with discrete model, binomial tree. So today we'll introduce continuous model and bit of stochastic calculus, and it will continue in the next class as well. But before we go there, we did quite a bit of things in the last three classes or so. We talked about a lot of different concepts from time to time. So I would like to go through an end-to-end example showing you, trying to show, I'll try to show the interconnectedness between all these concepts, how everything falls in place. Okay, so let's do that end-to-end example, and we'll see how all these concepts are tied up together, and then we'll transition to continuous models. Okay, so this is what we have been doing so far. um, what I have here is a two-step binomial tree. Okay, start with the stock process, right? And we discussed different definitions of process, pre-visible process, conditional expectation, Martingales, pre-visible process, right? So this is a stock process, and today the stock price is at 100 because in your model you have calibrated the up move factor and down move factor from the asset sigma, right? E to the power sigma square root of dt, and then e to the power minus sigma square root of dt. That is how we have calibrated u and d. Okay, we'll learn more details about it, how this is calibrated today, after this is over. And then based on your model, there are two possible states that it can either go up or go down. So you have established the stock price process. All right, starting from the initial stock price. As per your model, this is your process. Then, so this is random, right? There are two possible states. So stock price, definitely it's a random process. It can take different states at different times. Now we have a bond process. Actually, technically, the correct word to use is bank account process, which grows. All right. Assume the risk-free rate is 3%, which is constant for simplicity. $1 invested in a bond or a bank account will grow in this fashion. So this will be e to the power r delta t. Total time is 1 year. I've taken two steps. So each sub interval, basically one period is 0.5 years. Okay. Now, this is how the bond price will grow. It is deterministic. There is nothing random about it. We totally know how it will grow. So this is e to the power rt, then e to the power, e to the power r delta t, this is e to the power r times 2 delta t. Okay, is there any question on these two? It's pretty straightforward. All right, now we define a discounting process, which is the reverse of the bond process. Okay, so today the discounting factor is 1. Discounting process means what's the discounting factor that you will be using at different time points to discount to today. So this is like present value factor. Okay, and this is exactly 1 divided by the bond process. So here you have 0.98 discounting, here you have 0.97. It will keep on decreasing because the farther the cash flow is in future, the discounting factor will be higher. That we know. So discounting process. Okay. Now we talk about discounted stock process. Discounted stock process is pretty easy. Basically, you are just discounting all the states of the stock price to today. How do you do that? It's simply multiply the discounting process with the stock process. Discounting times stock. That will give you the discounted stock process. Okay. This means stock price at this node discounted to today. This is stock price in the down state after end of first period discounted to today. Okay, this is stock price in the up state after the end of second period, discounted to today. All right, any questions so far? Is it clear, guys? Clear. Okay. So this is till now this is straightforward. What is the use of discounted stock process? We'll come back to it. Just give me a minute and we'll come back to it. What is the use of discounted stock process? All right, we'll come back to it. Now we define claim. Claim is the our in our case it's a European call option. It's a claim. It's a claim on the stock price at the end of the second period or at t equal to capital T 1 year. Claim is defined at the expiry. All right. So we are saying at the expiry, whatever the stock price is, which is in our model S2. Okay. Three possible states. Claim is S2 minus K and maximum of that and zero, right? So the payoff or the claim as per our model is defined here. Okay. Now, please understand that this is the only place. Expiry is the only time we can say the payoff is equal to the price. There is no doubt about that, right? Is there any doubt? Because you see at expiry, it will pay 12.33 here at expiry. If the stock price, excuse me, at expiry, if the stock price is 107.33, then the option payoff would be 12.33. So at expiry, what is the price of the option? 12.33. There is no, well, you are standing on the date of expiry, it is giving you 12.33. So that's like the value of that option is 12.33 on expiry. Clear? So at expiry, payoff is equal to price. Is there any question on that? Okay, all right. So this is important. Now, so we only know that the price of the derivative at expiry is given to us. These are the prices of the possible prices of the derivative at expiry. I'm talking about price, okay? From claim, I went to price. Expiry is the only place I can say confidently my claim is the price. There is no discounting. It's immediately it's giving you 12.33 in hand in the up state. So that's the price of the derivative. There is no present value or anything. You have already come to expiry. Okay. So that's the price of the derivative at expiry. What about the intermediate points? So you see from claim, I went to price. So I know the price of the derivative here is the payoff. But I don't know what the price will be before at these points. I don't know what the price will be. Okay. So what do I do? So we have used the replicating portfolio strategy. So basically we'll synthesize a portfolio consisting of stock and bond, right? And replicate the option payoff. If we can exactly match the option payoff, then the replicating portfolio will be exactly equal to the option. The value of the replicating portfolio will be the value of the option. That's the whole idea. And we can do that because it's the complete market. That means stock and bond are the two sources of changes that drive the option price. There is nothing else. There is no other risk factor. It's stock or bond. So mixing stock and bond in an appropriate proportion, we can mimic or mirror the payoff of derivative. All right. So let's do that. I have not used probabilities anywhere till now. No physical probabilities at all. Okay, or any kind of probability that I've used so far. I've not used any probability or expectation or anything. Okay. So we know derivative price here. All right. What is the composition at this node of stock and bond? that will result in 12.33 if the stock moves up, or 5 if the stock moves down. That's the whole idea. And that's pretty simple. So at this node, what is the stock price? 103.59. So and bond price is 1.0151. So alpha times 103.59 plus beta times 1.01, right? That's the portfolio, will become 12.33 if stock price moves up, or will become 5 if stock price moves down. Clear? So in both states, whether stock price goes up or goes down, my portfolio will exactly match the derivative price. And so using these two variables, alpha and beta, I can satisfy two equations. There are two equations. So alpha, you see, I have taken alpha times stock plus beta times bond. So in the up state, my portfolio will become alpha S up plus beta B up, which will match the derivative price in the up state. Similarly, the same alpha beta combination in the down state will also match the derivative price in the down state. Okay, two equations, two unknowns. I can solve alpha and beta. All right. By the way, bond price in the up state and bond price in the down state are exactly same, because bond price is not random. Whether stock moves up or stock moves down, you see the bond price is the same. It is deterministic, e to the power rt or e to the power 2 rt. Okay. So how to solve this equation? You just subtract this from this, or otherwise the second term will vanish because it's the same. So you get alpha immediately equal to value of derivative in the up state minus value of the derivative in the down state divided by value of stock in the up state minus value of stock in the down state. After you get alpha, you put it in this equation and you get beta. So that is how you come up with the composition of alpha and beta in each state. Okay, so let me just quickly do that. So we'll do this only once so that you understand the end-to-end example, martingales and self-financing strategy, arbitrage and everything all together in one master example, and then we'll move to continuous models. So I know price here. So these are the derivative prices at expiry. I will choose alpha and beta in such a way. So my alpha would be, this is stock, my alpha would be V up minus V down divided by S up minus S down. Alpha is 1. What is beta? Beta you can calculate from one of these equations. So I'll use the first equation, which is V up minus alpha S up by B up. Okay, V up minus alpha times S up divided by B up. B in the up state is this, correct? Okay, right? And similarly, let's complete this one. So for this node, in the up state, my derivative price would be 5. In the down state, my derivative price would be 0. And corresponding stock states are 100 and 93.17. And bond is always same, 1.03. Okay, so let's do that. Alpha is V up. I can use this. I'm talking about price. V up minus V down divided by S up minus S S up minus S down. Correct? Yeah. And then beta would be V up minus alpha times. So you'll do this again with Karan. Trust me, this will give you a lot of dividends once you do the whole thing by yourself. So you'll do this again with Karan. All right. So today you just understand how everything is connected. V up minus alpha times S up. S up, this one, divided by B up. Okay. All right. So this is the composition of stock and bond at this node, which will guarantee 12 point, this will become 12.33 in the upstate and 5 in the downstate. Okay. So replicating portfolio, let me see. What is the portfolio value at this point? That is alpha times, oops, alpha times stock. Stock in this node is what? 103.5988. So these are alpha and beta are the units of stock and bond you are supposed to hold. Okay. I got the units, but what is the portfolio value? So this is the stock value, 103.59. What is the bond value? Bond value. So I'm short on bond. This into bond value in this node minus this. Okay. Similarly, let's complete this one. This is equal to 0.73 times stock in this state. This is the stock portfolio. Bond portfolio is this times bond price, bond portfolio. All right. Let's check if this actually becomes our derivative price. That was the whole intention. So if this is my stock portfolio, in this state, what it will become? This is up, stock moving up. So this times up factor, this is up factor, and bond will become, bond grows at risk-free rate, right? So this into e to the power r delta t. This is what my bond will become. Okay. Together, if I highlight these two, you see below here in Excel, the sum is 12.327, which is the derivative price. This is just trivial because we calculated alpha beta in such a way that it will match. Okay, so we don't need to be surprised. Similarly, below, stock will become, this is my stock, down into down factor, which is 0.96, and bond will become, bond is always growing at risk-free rate, e to the power r delta t. And you can see clearly the sum should be 5, right? Which is the price of the derivative. Similarly, in this state, it will be stock times down factor. Stock is going down. Bond is always risk-free rate, grows at risk-free rate. So if I add these two, you can see they perfectly counter each other, right? Same value. So this is 0. Derivative price is 0. One question might be here is that we calculated this from here by making a down movement, correct? What about, so this can go up and it should also match, right? So let's verify that. Stock, if it moves up from that point, it will be this times u, and bond always grows at risk-free rate, r times delta t. If I highlight these two, you see the sum is still 5. Okay. So derivative price at expiry is matched. I have that magic portfolio made up of stock and bond, which I totally know. I know exactly how stock price evolves. This is per model. I know exactly how bond price evolves because it's a risk-free instrument, so it grows at risk-free rate. So I know everything about stock and bond. Not deterministically, but at least I know all the possible states, correct? So using stock and bond, I could manufacture a strategy, a replicating strategy that could match my derivative. Now, since this matches the payoff of the derivative, there is no difference between the portfolio and the derivative. They have the same payoff structure. If two securities have the exact same payoff structure, then their price today should be same. Otherwise, there will be arbitrage, right? Two securities have the exact same price tomorrow. So today, the price have to be same. So if that's the case, otherwise there will be arbitrage. So I did not know the price of the derivative at this point, but I know the price of my portfolio, and that should be equal to the derivative price. So price of my portfolio is just sum of these two today. So that is 10 point whatever it is. Let me write that here. So indirectly, we could come up with the price of the derivative using a replicating portfolio strategy. Clear? Any question till this point? Any questions? Clear? All right. Now you look at these two, exactly how we looked at probably these two and came up with this. So we can look at these two and come up with this. So let me quickly do that. Alpha would be the upstate derivative price, come on, minus V down divided by S upstate minus S up minus S down. That's alpha. And beta is V up minus alpha times B up, alpha times S up divided by B up. So this is the alpha and beta. If this is the alpha and beta, what is the value of my portfolio? Value of my portfolio is simply 0.92 amount time 92 times stock value. Stock value at t equals 0 is 100, and bond value at t equals 0 is whatever it is, this many units of bond times 1. This is my stock portfolio and bond portfolio at time t equals 0, which is supposed to match the derivative price. Okay, let's check that if it is matching or not. So this is equal to, stock will go up and become this, bond will grow at risk-free rate, R delta T, and in the down state it will become, stock will go down, bond will grow at risk-free rate, okay. This together is 10.0131, which is the derivative price. Cool. And this thing is 3.471, which is the derivative price. So I have matched the derivative payoff at the end of time. So this is not payoff, sorry, my bad. This is the price of the derivative. Payoff is only here. This is my payoff. Payoff equal to price at the expiry, no doubt about it. So from here, I could calculate the price of the derivative one time tick earlier using replicating portfolio strategy or no arbitrage strategy. And continuing the same argument again, I could calculate the price of the derivative here. That is this plus this. So this is my portfolio today, which is matching the derivative price in the next tick. So 7.96 is the price of the derivative, and I calculated it using purely replicating portfolio strategy. There is no probability or expectation anywhere. I have not talked about those. Okay. So this is good. The only caveat here we need to check is we need this composition to match the derivative price here and here. We need this composition to match the derivative price here and here. Okay, let's focus on this one. We need this. We need this at the end of first period to match the derivatives in the both states. But when we started from here, we got to here. But we need here, we need this composition, but we got this composition. All right. Now both are same. Composition is different. Both are same because both of these are the same derivative price 10.013. So you look at the sum here 10.013. Look at this one which we need to replicate the payoff in the next period. That is also 10.013. So there is, you don't need to take out any cash or invest additional cash to ensure that your portfolio is replicating. Okay, so this concept is called as self-financing strategy. The portfolio self-finances. You just have to rebalance. Keep updating the weights or rebalance the proportion, but you don't have to put any more cash in. So then it becomes a proper no arbitrage strategy. You just have to come up with the initial composition that this is the only investment you have to make in your life. Borrow money or do whatever. Just ensure that you have this at t equal to 0, and then just every period rebalance, and you can chase the derivative. You can keep chasing the derivative exactly. Okay, so this is the no arbitrage strategy, and we understood how self-financing is also in place. All right. Okay, till now no expectation. Now the big thing is we want to calculate price using expectation. That is in our nature, right? It is the most intuitive thing to do. If something is random, there is some cash flow happening in future which is random. So what is the price of the security today? The most natural thing to do is, okay, what is the average payoff? I know it is random, but tell me the average. I will discount that average. That is the most natural human thing to do, correct? But we saw that that has problems in real world because expectation calculated using real world probabilities is different from the enforced price because of risk aversion and all the other things. Still, we want to use expectation. So what we do? We use some other probability, not the real world probability, some fake probability, some tweaked probability such that the price actually matches. All right. So how did we do that? We look at stock price first. First, we look at stock price. Now, the fake probabilities, also called risk neutral probabilities, Q, are created in such a way that the stock price grows at risk-free rate. Well, let me correct that. Stock price on an average grows at risk-free rate. So you'll always find the expectation of the stock price in future is growing at risk-free rate. That is how the probabilities are created. All right. So, so we have seen that, right? If you choose this probability, if you choose these two probabilities, then if this is my stock price today, my average, if I use these two probabilities, this average grows at risk-free rate, or I can write expectation is S now e to the power RF delta T. That is how these probabilities are calculated in the first place, making this equal. Okay. Now, if the average stock price grows at risk-free rate, if the average stock price grows at risk-free rate under risk neutral probability Q. So Q is just Q and 1 minus Q, this pair, okay? If the average stock price grows at risk-free rate under this probability measure, then if I discount the stock price using the same risk-free rate, the discounted stock price will not grow at all. Make sense? If I discount these two guys, it becomes a discounted stock price process. if the average stock price grows at risk-free rate, the discounted stock price will not grow at all. Basically, I'm just rearranging, nothing magic. RF delta T. If I discount this and this by this factor, then my expectation of discounted stock price will become this. Agree? And that from this equation it is S now. I have just taken this to the other side. It is very simple, guys. See, expected stock price grows at risk-free rate. Okay. So average of the stock prices here, would grow at risk-free rate. If I discount these future stock prices already, then the average would remain equal. It will not grow. It's very simple. So what I will do is discount. What is the average of discounted stock price? What is the average of discounted stock price? So it will be, one second, Q times average of or expectation of discounted stock price, same probability. I'm talking about probability measure Q here. Under probability measure Q, the expectation of discounted stock prices, these are the discounted stock price process, remember? Discounted stock price, average expectation of the discounted stock price is equal to, take e to the minus r delta t comma outside, QSUP plus 1 minus QS down is nothing but expectation of S. And I know expectation of X grows like this. So if you plug in this value, it becomes S now. It's very simple, very, very simple. Average stock price grows at risk-free rate. Discounted stock price will not grow at all. Average value of discounted stock price. Average value of discounted stock price will be equal to the previous value, as if there is no growth. Do you need more explanation? Two clear pictures you have to have in your head. This is stock. Future expectation under probability measure Q is this. All right. This is discounted stock price. I'm calling that S star. So all the stock prices have been discounted to today. All this in the entire stock price process, each of the stock prices have been discounted to today. Okay. If there are further, branches, then this would have been discounted to today. So we saw that from the discounting process. So if this is a discounted stock price process, then average value expectation of discounted stock price in future node, in this node, the expectation of that is equal to S star. Is it clear or you need more explanation? So basically, if I simplify this, Q times, so I'm taking expectation means what? Q times up plus 1 minus Q times down. Q times up is discounted stock price in up state plus 1 minus Q times discounted stock price in down state. Okay. Now that is equal to Q times what is discounted stock price in the upstate? It's upstate stock price times discounting factor. One second. Discounting factor applicable to that one period. Okay. And why did I take Q common? So this, okay, 1 minus Q. Discounted stock price in the down state is nothing but S down times discounting factor. All right. And this is equal to, so if you take e to the power minus R delta T outside, QS up plus 1 minus QS down, which we know is this guy. Which is the expectation of the stock price under its neutral measure. All right, I've taken the discounting factor outside. So that, but that is nothing but this S times e to the power R delta T. So S, so this gets cancelled, I get S. And don't be surprised that S is equal to S star. S equal to S star. Can you tell me why S is equal to S star? It's a very simple question. S is the stock price. S star is the discounted stock price. In this node, at this node, what is the discounting factor? No, what is the discount? So in the discounting process, what is the discounting factor today? Discounting process. 1. This is the discounting process. Agree? We have seen this, right? Present value of a cash flow today, for that, what is the discounting factor? 1, there is no discounting at all. Okay. So discounted stock price and stock price match at origin at t equals 0 because the discounting factor is 1. Okay. So S equal to S star at this point, but S up will not be equal to S star up because there is a discounting factor e to the minus delta t involved here. This is S up e to the minus R delta t, and this is S down into e to the minus R delta t. This is very fundamental and very important. So if there is any more question, let me know. It's straightforward. Just, I mean, from a layman's point of view, right? Expected stock price in future would be, you will see a growth of RF under Q. Expected stock price under Q would be growing at risk-free rate. So if I discount the whole process using risk-free rate, should there be any growth? Simple. Does it make sense? Is it clear? Mathematically also we saw. Clear? Okay, awesome. Just do it one more time yourself, you'll understand. It's very simple. I mean, it is clothed in a lot of technical jargon, but the concept is very straightforward. Now, important thing, if the discounted stock price process is not growing at all, that means expected value of the discounted stock price in future is going to be the same as the discounted stock price today. No growth means what? So we found this result. Expected value of stock discounted stock price in future is today. Agree? Discounted stock price under Q. This is important. When we write expectation, we absolutely have to define what is the measure. This is under risk neutral measure. Under risk neutral measure, there is no average growth of discounted stock price. Clear? If the expectation of in future is same as whatever the value is today, what do we call this? What is this process called as? There is no growth. Something, so you observe that value today, future expectation is what we observe today. Future expectation of something is exactly what you are observing today. There is no growth, no drift. This is called as Martingale. So I'm writing here discounted stock price is a Q Martingale. Q Martingale means Martingale under Q measure. Clear? Discounted stock price has no growth because I have already discounted. Why would it grow, right? Discounted stock price is a Martingale under Q. Now, naively, we have made this statement in the beginning that risk neutral measure is such a magic measure. This probability, this pair of probability Q and 1 minus Q are such magical probabilities that makes every asset grow at risk-free rate, even the derivative. That is what we claimed. We will see that that happens. Okay. So all right. So let's see that. Let's actually verify first whether the stock price process is really discounted stock price is really a Martingale or not. So can we verify that? Yes. Where is the discounted stock price process? The discounted stock price process. And guys, I'm telling you this end-to-end example, but believe me that there is, let's say there are 20 items to be talked about. There is one exact sequence in which you have to tell those items. If you change the order of the items, it will not make sense. So when you read from other areas, they will explain these concepts separately, but it will be very difficult to tie them together unless you tell everything in one exact sequence. So that is important. That is the whole reason why I wanted to do this today. We did not use expectation till now. We did everything using no arbitrage. And we also saw the role of self-financing strategy. And we derived the derivative price using purely no arbitrage arguments. But we want to be efficient. Can we do something nicer or rather easy to deal with? We don't have to create replicating portfolio rebalancing strategy every single time. We don't have to take that headache. Can we do something using expectation? If yes, what is that? So we saw that the discounted stock price process is a Martingale under Q. Quickly, let's verify that result. So I have here a Martingale checker, basically. It does nothing. You just put two future states in the future, and it will calculate the expectation under Q. So Q times up plus 1 minus Q times down, and whatever that value is, it will show here. Okay, so this is the formula basically. You see, Q times up plus 1 minus Q times down. So discounted stock price is this. So let me put a couple of values. This and this. You see the expectation of discounted stock price is 100, which is exactly what is the value today. All right. The average future value remains the same. Is equal to what you have today. That is the feature of Martingale. So discounted stock price is a Martingale. If you try these two, you will get this. Let's do that in case you don't believe me. So let me do that once. 102.056, 102.056. Similarly, you can try these two values. The expectation under Q would be equal to this. So this is the Martingale property. Now, Martingale tells something more. It's not just the value in the previous time tick, right? It is saying the last known value. That means if I'm standing here today, which is exactly what this whole case is all about. I don't know anything in future. I'm simulating or modeling. I only know the values today, which is 100. Tomorrow it can be anything. Standing today, if I see the stock price is 100, which I know is also the discounted stock price today because there is no discounting factor today. Discounting factor today is 1. All right. There is no discounting factor today. It is 1. So 100 is the stock price. 100 is also the discounted stock price today. I'm standing at today. I'm looking at the discounted stock price. It is 100. And I know that it is a martingale. So can I say that if I take the expectation of these values, it will still be 100? After all, it is a martingale, right? If the last known value is 100, always in future you take any future value, any possible states in any future point of time, the expectation of that would be the last known value. So you can stand here and make the comment, because from here you cannot go here. From here you cannot go here. From here you can only go to these two places. So the future expectation of these two standing here would be 102.056. But from here, the future values could be these three possibilities. So you have to take the expectation of all future values, correct? This is the expectation. You have to take the average of all possible values. So standing here, if I take the expectation of all three values, I should get 100. Let's test that. So that would be three values, right? Q times, no, not Q times. What is the probability of this particular state? It's two up states, right? So that would be Q times Q. So Q square times this value plus, so I'm standing at today, 100 is the value. And I'm looking at the expectation after 2 periods. Plus, it will be Q into 1 minus 2, 2 times Q times 1 minus Q times the middle value. This is the middle value plus 1 minus Q whole square times the down value, this value, right? I'm taking the expectation of discounted stock price, which is already a martingale. So I don't have to discount anymore, right? It is already discounted stock price process. So simply the expectation should be equal to the last value. 100. Is this clear? The whole idea of martingale and discounted stock price process and how everything fits. Story is not finished yet. We have to talk about the derivative. Stock prices, anyways, we knew the values of the stock price as in the possible states of the stock price already because we modeled it. We'll look at the derivative. So, but any questions on the discounted stock price being a martingale under Q? That's clear, right? I would take silence as confirmation. So let's look at the derivative price process. Now, this derivative price process, did we use expectation? No, we calculated the prices of the derivative at different points using purely no arbitrage strategy. Now, curiously, we have to definitely check is what about discounted derivative price process? We looked, so stock is an instrument, derivative is another instrument, right? Discounted stock price is a martingale under Q. What about discounted derivative price? So let's look at that. Discounted derivative price. Is there any, oh yeah. So here the discounted value of the derivative will be derivative times, this is the price at expiry, times discounting factor that applies here, which is where it is. This is the discounting factor, correct? You see it is heavily discounted because it is after 2 periods of time. So we are discounting everything to today. All these discounting factors, right? These are discounting factors for today. Discounted derivative price, and in the down state the discounted derivative price would be this into 0.97. So discounting factor is same because it's everything is after period 2. So this would be 0 times this. Here the discounted derivative price would be, this is the price, discounting factor is this, and this is the price, discounting factor is this, and today there is no discounting factor. So if the price of the derivative today is 7.96, the discounted derivative price is also 7.96. Okay, but still let's just do that, this into 1. This process is the discounted derivative price process. Is this a martingale? Let's check. Oops. So where is my martingale checker? In upstate, my value is this. In downstate, my value is this. 9.864 is the discounted derivative price, which is also the expectation. You see, this is also the expectation. In this entire structure, I never used any expectation. From no arbitrage, I went to discounting. I did not use any expectation. No, first time I'm checking whether the derivative price is actually a martingale or not under Q, and it is. It is a martingale. So if you take the other two values, this is the upstate and this is the downstate. So I'm standing here today. I'm looking at future prices. These two are the future possible prices. There is no other future possible price. What is the expected discounted derivative price tomorrow? That is this 3.42, and it is matching the current value, correct? So discounted derivative price process is also a martingale. Similarly, you can take these three values and check the expectation of these three values. From today's perspective, it would be exactly 7.96. All right, so this is a big result. And in quant finance, martingales are very important for pricing. There is just one small argument left. That is, once we know that a process is a martingale, so let me write that here. Price of derivative today is equal to, first of all, this is a very naive statement. Discounted price of derivative today. What is the reason for this? Price of derivative today is equal to discounted price of derivative today. Why is it true? It's a very simple statement. Why is this true? No, don't go with expectation now. This is a simple statement. Price of the derivative today is discounted price of the derivative today. Yes, at t equal to 0, there is no discounting, because discounted price of derivative today is simply 1 times price of derivative today. Be very careful with what claim we are making. So this is all about this argument, right? So step by step. So price of the derivative today is 1 times price of the derivative today. One is the discounting factor today. So this actually is, we can call this as discounted price of the derivative today. Okay, so in the discounted derivative price process, the initial value, first value actually matches with the price of the derivative. Why? Because the discounting factor is 1 today. But we know that this discounted price of derivative today has to be, let me use some symbols. Price of the derivative today is C0, call option, which is also equal to discounted price of the derivative today, because there is no discounting is 1. But I know that the discounted price of the derivative is a martingale. So if this is the value today, is it not the expectation of call prices, discounted call price in future? Martingale. This is a martingale. Discounted call price is a martingale. So discounted call price today must be equal to the expectation of discounted call price in future. This is coming from Martingale property. I must write Q. Is this clear? Future expectation is today's value. That's all. If it is a martingale. What is a martingale? Discounted call price is a martingale. Call price is not a martingale. Discounted call price process is a martingale under Q. So future discounted call price, expectation of that should be equal to today's value. We can go up to any future point in future. Not a problem. If you're standing today and today we are seeing the value, we have not seen the future. We can say in any, after 10 years also, it's a 10-year contract, right? Then the expected value of discounted call price after 10 years also will be exactly equal to the value today, because it's a martingale. All right. How can we make sense of, add more meaning to this? Do we know the price of discounted call price at any point in future for sure? Yes, at expiry. At expiry, we know the payoff is price. So discounted price would be discounted payoff. In between, we don't know the price. It is saying value of discounted call price today, which is same as value of the derivative price today, is expectation of discounted call price in any arbitrary future. But do we know the price of discounted call price or call price in any point, intermediate point? We don't know. But we know that at expiry, what the price is. Price at expiry is payoff. That much we know. So we can take this to expiry. At expiry, I'm writing this. Discounted call option price at expiry. This is equal to discounted call price. I'm not writing call price anymore. I'm writing payoff. So discounted payoff. Is this flow clear? This might sound very trivial to you, but this is absolutely what is happening behind the scenes. And we have been using this result all along when we are taught options in FRM or whatever, wherever you learned option, how to price a European call option. Okay, what is the payoff? Discount it back to today, and we got the price. This entire theory is working behind the scenes. You see, value of a call option today is expected discounted payoff under risk neutral measure. Now you see where the formula is coming from, and you see the role of martingales in this entire argument. We use this without knowing the background theory, right? Call option, so easy, super easy. payoff, 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 discount everything to origin using risk neutral probability, and we are done. Why does that happen? Why is it true? Because discounted call option price is a martingale under Q, and this entire chain of arguments is the reason why this is true. So that was my whole agenda for showing this end-to-end picture of what we have been doing so far. Is this clear? Any other question? Any questions? Now you understand why martingales play an important role. Whenever you can, if you can prove that an asset price is martingale or discounted asset price is a martingale under some measure, then you have a formula for pricing. Okay. So we'll move on. Any questions? Question from here, by this method, we can prove any asset to be a martingale. Yeah, I mean, plain vanilla ones, yeah. European options, European call, European put, definitely. Even Asian options also. If you can find the payoff, if it is a martingale, you have to prove it's a martingale. So there are other theories. I mean, you can use. So we saw that it is a martingale looking at no arbitrage replicating portfolio through Excel. But in continuous domain, you can actually prove that something is a martingale, taking expectations, and theoretically you'll derive the result. Okay, expectation is matching the current value, hence it is martingale. Once you prove something is a martingale, pricing is super easy. Today's price will be future price. Some kind of connection can be established, right? And future price, I can take future price to any extent, and I can take it to expiry. At expiry, payoff is the price. So that's the whole. As long as you can prove an asset price is a martingale. For example, American options are not martingales because there is you can exercise those early prior to expiry. So it's a complicated function. We'll talk about it later, but that's complicated. It's not plain vanilla. It's exotic, sort of exotic. American options are not straightforward, right? They are more popular, by the way. They are, I mean, as far as trading is concerned, because they give investors, better flexibility. So pricing American option is tricky, but as far as European plain vanilla European options are concerned, which can only be exercised at maturity, then as long as you can prove that it's a martingale, you can just take the discounted payoff as the price. Okay. All right. I think we should take a break here because we'll start the new topic. Let's take 5 minutes break. All right. Meet after 5 minutes. Okay, let's resume. So we'll slowly go to the continuous model. We'll leave the discrete model behind. Um, I know last class we talked about simple random walk and a little bit of scale symmetric random walk, other stuff. So let's go through those again. Okay, a little bit thoroughly. So let's introduce simple. This is a fundamental idea of modeling randomness. If you want to model randomness, at least you will need two states. Okay, simple random walk is based on that idea. So here we have a step and here we have a walk. Step is just one step, which is random. I can go up or go down. Very simple. And walk will consist of a series of steps, all steps, stitched together that will take you from one point to another, correct? So model step as +1, -1, very basic, extremely basic modeling, model for randomness. Okay, so this is a step, and after n steps, so I'm walking n steps, okay? After n steps, so if this is my starting point at t equals or before any steps, I was at y0, then after n steps, I will reach here, sum of n steps, wherever it will take me, okay, from y0. What is expectation of x? Expectation of x, I am waiting for an answer from you. Expectation of x, expectation of x is 0. 0.5 times 1 plus 0.5 times -1. Variance of x is, can you tell me variance of x quickly? Variance of x, variance of my one step is 1. How is it 1? 0.5, 1 minus 0 square plus 0.5 minus 1 minus 0 square. All right. Okay, so what is my expectation of y after n steps, where I will be on an average after n steps? Y0 is a constant. This is where I started from. Expectation of y0 is y0 plus, since expectation of each of the step is 0, after n steps also, as if I have not moved at all, because the expectation is 0. And variance will be, variance of this is 0. Now these are all IID, identical, because all of these steps are coming from the same distribution, 0.5 plus 1, 0.5 minus 1. So identical. Also independent. That means it doesn't matter where I am right now, my step will always be independent of all previous steps. There is no dependence. There is no dependence on the current location or how I have taken steps in the past. It's all independent. If it's independent, then variance of this would be just sum of individual variances, which is n times 1, that is n. Okay. So this is true. Now, if n is large, many number of steps, then you expect yn to follow normal distribution with mean y0, because that is the expectation, and variance n. Already I calculated the mean and variance, so that is fine. But it will be normal also if n is large. There are two ways to do this. In fact, actually, there is the same method. Why this is true? So last time we said that it is because just 1 second. Some reason I'm not able to scroll. Anyways, let's take take another page. So yn is y0 plus sum of xi, I equal to 1 to n. And we're claiming that yn is normally distributed with mean y0 and variance n, correct? Why it will be normal is, look at this particular quantity, because this is the only thing that is random, right? This is not random, this is known. So this quantity, this is adding n different or n independent Bernoullis, which is binomial. And we know if n is large in binomial, it approaches normal distribution. Okay, so this would be normally distributed with mean 0, because the steps, each of the steps have an expectation 0. In case of binomial, the expectation gets multiplied by n. So this is n times 0, which is 0. And the variance would be n times individual variance. You remember binomial to Bernoulli, right? P and P1 minus P. Mean variance. In case of binomial, it will be just be NP and NP1 minus P. Just you multiply n in both mean and variance. That is what we have done. And of course, the other approach would be from CLT. So these are connected. CLT states that sample mean would be normally distributed with variance equal to population, with mean equal to population mean. Population mean is 0, 0, 0, 0, 0, so so I'm drawing n samples from this distribution. This is the distribution. I'm drawing n samples from this. Population mean is 0. So sample mean would also be 0. And sample mean, the variance of sample mean is population variance, which is 1, divided by n, correct? Sigma square by n, if you remember. So if this is the distribution, then sum of xi, I equal to 1 to n, will be distributed with n 0, and variance will go as n squared by n, which is 0n. Correct? So this is n times something that is normal. So n times, call it, what should I call it? D. This is D. Variance of this is scalar square times variance of whatever the variance of D is. Okay, so that is what I've done. N square times variance of that was 1 by n. So 0 to n. So either way, both are same. So we derive the distribution of yn from simple random. In case of simple random walk, yn is normally distributed wherever it started from, and then variance n. Okay. Yeah, so this looks like after n steps, if y0 is my starting point, keeping y0 as mean, I'll have a variance like this. Okay, and the variance of this is n, and mean would be y0. All right. If I increase the number of steps, what will happen? We have a visual, but I'm just trying to show you without the visual. If I increase n, n dash, it has increased. Same mean, but now it will be more dispersed. So little bit fat tails. Something like this will happen. Okay. More variance, so more, it will be dispersed more and more and more with increasing number of steps. Having said this, what is the limitation of this model that we developed? This is the way we are trying to model randomness. What is the limitation of this? Limitation is, if I am trying to model a process, it could be stock price process or interest rate or any random process I'm trying to model. At t equal to 0, and I'm trying to see where I can go, where the process can go after time t. Okay. Problem of using this particular model as is would be that this is dependent on number of steps. I don't want the process to depend on number of steps. Number of steps is arbitrary. It is up to me. I can choose 10 steps in between the 0 to t. I can choose 100 steps. I can choose 1000 steps. But variance is increasing with respect to number of steps. Okay. Variance is increasing with respect to number of steps. I don't want variance to increase with number of steps. I want the variance to increase with t. It makes sense. It makes sense that if I'm looking at distant future, if t is big, distant future, then the possibilities are, I should have more possibilities. If I'm looking at near future, I should have less possibilities. We will see this, don't worry, but I'm just, from a layman's perspective, this is the expectation, right? If I'm looking at a stock process, which is currently at 0, let's say, anything that is 0, interest rate is 0 or whatever is 0, something is 0, what can happen in the future? In near future, you don't expect super huge swings. You can expect after 10 years, maybe yes, this can go to any extent. So the variance should depend on the time, right? Time for which you're trying to model this process, but it should never depend on number of steps. Number of steps is arbitrary. That is my choice. I can make this 10 steps, 100 steps, 1000 steps. That is up to me. All right. So what can I do? What can I do to ensure that this process, the variance of this process, depends on time and not number of steps? Any guesses? What can I do to ensure that the variance is dependent on t and not number of steps n? Or let's take a simple case. I want to have this variance. Simple t. Whatever my t is, I want my variance to be t. What can I do to this process to have a variance of t? We are slowly going to continuous, but in discrete settings, what can I do to ensure that the resulting variance of my random walk is t, which is completely independent of number of steps, independent of n. Imagine how we got from here to n. How did we get n in variance in the first place? It was n times 1, correct? In one step, the variance was 1. So when we added n steps together, the overall variance was n times 1 equal to n. So obviously we have to take a smaller step, right? And the step size should depend on n. It should not be just blanket 1 for always. It should depend on n, how many steps you're taking. If you're taking small steps, then the step size should be small as well, right? You cannot expect in 0.000000001 second you'll the step size would be $1 plus minus $1. No, if the number of steps is high, the step size should be small. So what we need to do is this process. Minus. Make sense? What is the expectation? Expectation is intact. Expectation is 0.5 of this plus 0.5 of this, which is 0. Variance of x would be what? 0.5 t by n plus 0.5 t by n. T by n. All right, and assume I have broken down this entire interval into n steps, obviously. So t by n is delta t. Delta t is a small time interval in each in this step. Okay. What happens when I do a sum? Sum of steps. So this will have a mean of 0 because you're just adding a bunch of 0. But variance would be how much? N times t by n. Are there any questions? Mihir has a question, can we estimate n? No, see, choice of n is arbitrary, that is up to me. I can increase n to improve the accuracy of the model, correct? And I can increase n to infinite extent. I can make n tends to infinity, and this process will become continuous. That we will do by increasing n infinitely. But choice of n is arbitrary. That is the whole reason we did not want the process to be dependent on number of steps. Correct. Sachin asks, why did we take square root of t by n? You look at this process just to have, so my target was, how can I have variance of t? How can I have the variance of t? This is, if I do this, then I can have variance of t. So this is a calculation of variance. Do you have a question here? Probability times square root of t by n minus 0 whole square. Let me write the steps in case you missed. This is the variance, correct? So this leads to t by n. And when you do n times t by n, this is t. This is what I wanted. Okay, all right. Any other question? Any other question? Um, by the way, this process is called symmetric simple random walk. Simple, why? Because plus one, minus one. That's pretty standard, right? Plus one, minus one, standard. Simple. Symmetric, why? Because zero point 0.5, zero point 0.5. And your expectation overall is zero. This one is called scaled symmetric random walk. And you can see why it is called so, right? Symmetric because I'm preserving the probabilities which are equal, and scaled, obviously, this is scaled based on number of time steps. The magnitude of up move and down move is adjusted based on the number of steps you choose in your model. To make it look more neat, we can have this 0.5 delta t minus delta t by n is delta t, right? I'm just dividing the entire time interval by n small steps, not small steps. It's going to be large, but time period applicable to each step is now delta t. So this is square root of t by n. So I've used this. This is neat. This is called scaled symmetric random walk. And this generates a walk. In fact, you know what? Let me not use y0 because see, y0 is just the starting point. Wherever it takes you is what we're interested in. Starting point can be just as one separate condition. So this walk will be such that it will be normally distributed with mean 0. Now variance is t. All right. Okay. Next, how can I do more improvement? How can I do more improvement? I don't want variance to be t. I want variance to be sigma square t, where sigma is some asset specific sigma, right? T is very, standard, but for different assets, it will be different, right? Every asset has different variance. So I need the variance to be sigma square t. How can I do that? This you should be able to tell. How can we do this? What adjustment I need to do to this process to end up with this? Sigma multiplied, exactly. So this is what I need to do. We are doing series of small improvements to fit our modeling needs. Okay. If I do sigma square root of delta t and minus sigma square root of delta t, then this will take this process to this. Clear? And sigma is, let's say, annual standard deviation. So sigma square, annual variance. We know that this is what we typically use for modeling returns, correct? If annual returns have variance sigma square, then t period return will have a variance of sigma square t. Sigma square variance scales with time, not standard deviation. Variance scales with time, mean also scales with time. Here we are dealing with mean 0, so 0 remains as 0. So we are getting close to the real modeling, right? So our returns, we can all model like this in discrete fashion. Two states, okay? Up move, down move. All right. Now I want to add a little bit more richness. What is the deficiency of this model? Deficiency is this: no growth, zero growth. On an average, there is no growth. So I want to add some drift. It should have some deterministic growth. For example, mu t. Okay, I want a process that will give me this. I want this. This is a very common requirement for returns. Agree? What can I do to the model? We had till this. This was our model. Now we want some drift, non-zero mean. What can we do? I have deliberately kept some space here so that you know that we have to fill in something here. Add mu t, exactly. So we add not mu t, mu delta t, because this is one step, right? Mu delta t, mu delta t. You must have seen in FRM, this model is used in interest rate modeling, Holy model, and all other BDT and all those things, right? Now you understand where this is coming from. So it's not accidental. If you want a drift of mu t in the long run, you add it to the step and up move, down move. It's all natural, right? Does this really end up with this? If you want to check, so you can check expectation. Expectation is point, so zero point 0.5 times this plus 0.5 times this. What will happen? Sigma square root of delta t will cancel. You'll get 0.5 times mu delta t plus 0.5 times mu delta t. That is mu delta t. So we got the expectation here. No, I just verified, right? You see, because it's 0.5 and 0.5 here already. So when you add them together, expectation would become mu delta t. If it is not clear, let me expand it. Okay, all right. And variance, with this addition, does variance get affected? It does not. When you shift a process, randomness is not affected. This is a deterministic shift. I'm shifting the whole process upwards. I'm adding a trend. That does not. So basically what is happening is, instead of doing this, it will do this. This is time. All right, so variance would be 0.5 times this value minus mean. Mean is mu delta t, so only sigma square root of delta t square, 0.5 times minus sigma square root of delta t square, sigma square delta t. So summation will follow normal distribution, mean mu t, sigma square t. Clear? Okay. Now, again, suppose we modeled log returns. Using that, so this model fits a return. I mean, modeling returns, right? We have got mean, we've got sigma. So if I model, use this model, let's say t plus delta t and st, log returns in that small interval, 0.5. So here it is a little bit tricky actually. There is long-ended theory behind this, but I'll try to explain it using simple language. So if I used this mu delta t So this is delta t, okay, plus sigma delta t square root mu delta t minus sigma delta t square root. This will result in, I know this will result in, so I'm modeling from 0 to t. Let me draw it properly here on this side. Uh, 0 to t. Today's stock price is, let's say, S0, S0 here. And what is the stock price distribution here? Obviously, there is a growth, okay? And we know stock price will be log normally distributed. So we'll go there. Just assume for now. So this is some distribution. And this value is S0 e to the power mu t, okay? And mu, so your average stock price, you expect to land here. That is the definition of mu. Your definition of mu is that your average value of the terminal stock price is this. So does this model give me this and variance sigma square? Oh, let's see. So when I accumulate lot of these together, so sum of ln st plus delta t by st. So we are doing sum of x like we always did, right? Sum of x. Here x is log return in that small time interval. Then this will become normally distributed, correct? Mean would be mu t and variance sigma square t. This is what we proved. All right. And this is what, when you add the log returns, you get the overall return. St by S0 is normally distributed with mean mu t, variance sigma square t. Correct? Is there any question on this? So we know how we get from here to here, correct? All the denominator and numerator get cancelled subsequently, and we end up with terminal stock price on the numerator and the starting stock price in the denominator. The problem is, if you use this model, you end up with this distribution. This is the distribution of log return. It is not the distribution of simple return. Okay. If you use, so if mu t is the mean of log returns, which is what this model is about. If you use this model, you get the mean of the log return as mu t. And we know that if log of something is normally distributed, then that something is log normally distributed. So st by s0 is log normal. This is the definition of log normal. And we know the expectation of a log normally distributed variable is given as e to the power whatever the mean and variance parameters are in that normal distribution. We take e to the power this mean plus half this variance. Okay, so from here we will get st equal to s0 e to the power mu t plus half sigma square t. This was not our target, okay? Our target was my s, terminal s should end up here. That is the definition of my average growth rate. But I'm getting this. So I have to do some adjustment. I have to subtract. So I'm ending up at a higher average stock rate, stock price. I'm ending up at a higher average stock price. So I have to reduce the drift a little bit. How much I'll reduce? I'll reduce it this much. This is the overall reduction. Okay, this is the overall reduction. Then these two will match. If this is the overall reduction, then per time step, what is the reduction? This is the reduction. This is the reduction in per time step. This is the reduction in the drift in every step. that will ensure I get this. So my process should be, we will formally derive this result when we do Ito calculus, that is today towards the end. So that during Ito calculus it comes very naturally, so you don't have to do wreck your head. All right, so what we can do is, hold on, let me write it neatly. Mu minus half sigma square is the adjustment in the drift, plus sigma square root of delta t, and mu minus half sigma square delta t sigma square root of delta t. And so this will take me to this distribution. And this will promise this expected value of a log normal variate is e to the power mean of that normal distribution, whatever it was, plus half variance. Expected value of my average stock price in the at the end of t is this S0 will just go here. So now it is proper. Okay. There is a small difference, but it is very complicated to explain. It's better, to see that result in continuous model during when we do Ito calculus. But I'll just tell you this result is that simple return when continuously compounded, mu t. Okay. Simple return when continuously compounded is basically what we're doing is this. Agree? This is, so from annual to semi-annual compounding to quarterly compounding to continuous compounding. This is the logic. This tends to e to the power mu t because n tends to infinity. This is the limit that we saw a long time ago. So as per this, your stock price indeed ends up here. But if you take log of stock price st by s0, it is also giving you mu t. Okay, and yeah, correct. So here in this fashion, the simple return and the log return are matching. Okay, and they will match as long as there is no volatility. So all this adjustment is coming because of sigma square, correct? If there is no sigma square, this would have been fine. In both cases, you will get mu t, okay? Since we're talking about random returns, it's not deterministic return. When we studied all this continuous compounding or discrete compounding, annual compounding or continuous compounding, in those derivations, did we ever consider that the returns are random? No. We work with deterministic returns, always. When returns become random, there is a difference between how you model simple returns versus how you model log returns. Log returns, the mean of log returns will not be the same as mean of simple returns. So I'll give you a little more context, but this will come out very clearly in Ito calculus. For example, there is something called as Jensen's inequality. Okay, what is happening here is, suppose so st by s0, okay, this is log st by s0. This is the graph of log x, log of something, correct? Now this is a concave function, concave. Jensen's inequality is defined for convex, but the result will be exactly opposite in case of concave. So don't worry, I'll give you both perspectives. Now here, it's a very simple, elegant result. Through graph, it's very easy, but there is also proof for that. Consider 2 points here and here. Okay, so this is the function log of a function. So suppose this is x and this is log of x, correct? I'm plotting log x versus x. Suppose this is x1, this is x2. Value of the function at these 2 points is this. This is the value of the function ln x1, ln x2. And the average value of the function would be here, this point. This is the average value of the function. Average value of the function. So this point corresponds to average value of the function. Agree? What is the function of average value? x1, x2, this is the average value, average x. This is the expectation of x, average value. Just a second, guys. No, so one second. Let me correct it. Yeah, so the average value of x is here. Value of the function, this would be the value of the function at average x. Value of the function at average x, correct. Because ex is here. At ex, the value of the function is here. This is the value of the function at average x. So I did a mistake there. Okay. And what is the average value of the function? This is the, so to get average value of this and this, this is not drawn to scale. 1 second. This would be the average value of the function. Correct? Because you see, it's easy. So we are looking at 2 y coordinates, y1, y2. What is the average value of y? How will you get average value of y? How will you get the average value of y? You just join these two and find the midpoint. That is the average value of y. Okay, so this is the average value of y, correct? But what is y at the average x? If this is x, my y is concave, so it's not linear, it's always in this shape. That means at the average value of x, which is exactly at the middle, the value of the function is here because it's concave. So this value is value of the function at average x. Value of the function at average x. One is average of the value of the function. The other is value of the function at average x. Is just the difference between the order, okay? And if it is concave, then in the diagram you can clearly see that functional value at average x is greater than average of the functional value. Okay, this is Jensen's inequality for concave function. Concave means this kind of a function. This will be convex. This is convex. E to the power x will be convex. Log x is concave. Okay. Now, given this result, I can, so my function here is log x. Log is the function. All right. So I can say ln using this result. ln, let me see if I can scroll 1 second. There's something weird about this. Okay, let me rewrite it again. Concave function f of ex. So x is the independent variable and f is the function of x is greater than expected value of the function evaluated at x. All right. Here my x is st by s0 is a random quantity and function is log x f. So I can write log of expected value of st by s0, all right, will be greater than expected value of log st by s0. Okay, now you see the problem. I wanted st to be this on an average. I wanted this. In other words, I wanted this st by s0 to be on an average e to the power mu t. So I wanted log of e to the power mu t, correct? As per the inequality, it will be greater than expected value of log st by s0. Now log st by s0 is the log return, correct? This is the log return. So now I'm taking expectation of the log return. But how is my log return distributed? You see, I made the adjustment. Log return is distributed according to this. And the mean of the log return distribution is mu minus half sigma square t. Here t is, am I taking t? Okay, yeah. So the mean of this log distribution of log return is actually mu minus half sigma square t. And clearly you can see log e to the power mu t is mu t. This is t is greater than. So now you can see how much it is greater. This is the adjustment factor. Okay, when you use log return as the variable and you calibrate it, the mean of the log return is not same as the average growth rate of the stock price. So be very careful when you deal with stock price, distribution of stock price versus distribution of log return. So there is a catch, but don't worry about this rigorous proof. Just keep this in your mind. Jensen inequality is in finance. I think this is where it is mostly used to illustrate how they are different and what is the difference. But this result will come again. I've been saying this again and again. In continuous models, you will clearly see this result in one step. Okay, so you don't have to worry about these arguments so much for now. You can just skip it. All right, so one more result. So our final model is what? This is our final model. This is our final model for modeling stock price in discrete, using random walk. All right. One final adjustment we need. What is that one final adjustment? For pricing purpose. For pricing purpose, let me write it again. So we came up with a process which is this. We came up with a discrete process which leads to this average growth rate of the stock is mu. All right. Is this good for pricing? So after you model the stock price, then you will evaluate the derivative at different stock price possibilities, correct? First, you define the model for stock price, exactly how we did for binomial, up move factor, down move factor. After you model the stock price, then you calculate the value of derivative at different nodes. So this is the model of stock price. Can we use it for pricing? Question. Should the stock price be growing at a rate of mu for pricing purposes? By the way, when we say pricing, I want to strictly use expectation. I will use discounted payoff. I will use all those discounted derivative, discounted stock is a martingale under Q and all that. So can we use this as it is? No, because the growth rate is mu. What is the growth rate exactly? We need the stock price to grow at risk-free rate. All right. So this is the real world growth rate, real world growth. We cannot use this as is for pricing derivatives. So we have to do something. These are the real world probabilities. How do we go from real world probability, or rather real world growth rate, to risk neutral growth rate? Our technique so far has been change the probability. Change the probability in such a way that the growth would be risk-free rate. Okay. So how can we do that? What process will give me this? I want this. How can I change the probability so that I'll get this? Okay, so what is the expectation here? Expectation of x as it is. What is the expectation of x? Mu minus half sigma square delta t, correct? Agree or not? This is the expectation of x as it is. If we manage to get the expectation as this, then our job would be done, because consequence of this is this, and if we can ensure this, we will get this, correct? So what we need to do is assume the risk neutral probabilities are q1 minus q. So q times, there is something very magical that will come up. That is why I'm showing you this. And the connection will be not very clear. I can give you some intuition, but you will see the connection. It will be completely unexpected what you will get from this. That is why I'm trying to do this. So under new probability, my expectation would be one second. Under new probability, my expectation would be mu minus half sigma square delta t minus sigma delta t. I should match this. Okay, this is what Q should satisfy. This is a little bit long, but it's okay. It's just a couple of steps. So let me do it. Q times, keep this as it is. When we will do with interest rate modeling, we'll get longer equations. So this is just prepping you for what is coming in future. Um, I'm taking Q common, so I'll just take this part inside, okay? But it will be minus, right? So minus will come, and then it will become a plus sigma square root of delta t. I can close the bracket for Q. What is left over here is this 1 times the whole thing again, mu minus half sigma square delta t minus sigma square root of delta t. This is equal to r minus half sigma square. If you want, please write it in your notebook so that you can look at it later. Anyways, you'll get the video. So it's okay if you don't do it right now. That's fine. So this implies Q times, let's see, please cancel everything. So this whole thing gets cancelled. I get 2 sigma square root of delta t plus mu delta t I think, yeah, this and this gets cancelled. Mu delta t minus sigma square root of delta t equal to r. I missed a delta t here. R delta t. So here I get, if you look closely, actually, 1 second. Some reason it's yeah, it's came back. Thank God. Okay, so let's see. If you simplify, you'll get Q equal to take sigma square root of delta t to the other side and divide it by square this thing. So it will become half. And then what is left over is mu minus r delta t divided by sigma square root of delta t. I think that 2 would be here. 2 would be here, correct? Yeah, is this correct? And 1 minus q would be, so if this is half minus something, then 1 minus q and q together has to be 1. So this would be half plus that something. Okay. Now you can see that these were my physical probabilities earlier. Remember 0.5, 0.5? We have adjusted the physical probabilities by a little bit. So this was the probability for up move. We have reduced the chances of up move by bringing it down. And that makes sense because under physical probability, it was growing at the rate mu. Under risk neutral probability, it will grow at the rate of r. And we know that mu is always greater than r. Risky asset on an average will give you higher return than risk-free asset. So we want to reduce the probability of up move so that it doesn't grow that much, correct? And we increase the probability of down move so that overall effect is growth of R. But there is something very promising or very pleasant in the adjustment factor. Let's see if you can figure out what is so unique, or can you see if this is familiar to you somehow, this adjustment factor. Focus on this one. Forget about 2. 2 is just, for symmetry purpose. Can you identify this guy? In a step, in one step, the physical growth rate is mu delta t, physical drift is mu delta t, risk neutral drift is r delta t. Below you have the standard deviation of that step. Does it ring a bell? Okay, let me show you something more. Look at this part. Does it look familiar? Not really standardization. No, standardization would be x minus mu by sigma. This is, in the numerator, we have two different types of returns. One is physical growth rate or real world growth rate minus risk-free growth rate divided by sigma. Okay, let me tell you. If you're not able to get it, that's fine. This is called, now do you remember? So how pleasant it is, right? The probabilities got adjusted by something related to Sharpe ratio. And what is Sharpe ratio? Sharpe ratio is saying what is the additional return that you are generating per unit risk. If it would have been risk-free rate, there is no sigma. Risk-free asset grows at risk-free rate, constant. There is no volatility. For unit risk, what is the excess return that you are generating? That is Sharpe ratio. And that is the amount we use to adjust the probabilities to make it, to bring it from real world growth rate to risk-free growth rate. So you see how this is connected, right? Yeah. So before we, is there a mistake? Minus half in 1 minus. Oh, it should be minus. It should be minus half. But no, hold on. Why it should be minus half? 1 minus half is half, right? 1 minus q is 1 minus this quantity. 1 minus half is half, not minus half. Because together this and this, if you add them, they have to be 1, right? So half plus half is 1, and this term will get cancelled. Yeah, okay, no problem. All right, so before we pause for a break, and then so in the next session we'll talk about continuous models, but let's make that transition real quick, and then we can talk about continuous models and stochastic calculus. So in all this enrichment that we did step by step, we started from where? We started from simple symmetric random walk, long time before, here. We started from here, then we did slowly, we did enrichment. This was not adequate because it was dependent on number of steps. Then we landed here. Where is it? We landed here. This one. Okay. And then we did a series of improvements with respect to mu, sigma, and all that. But you see, mu and sigma are very much asset specific. Mu and sigma are very much asset specific. For IBM stock, it will be something. For Yahoo, it will be something else. So that you have to calibrate and put in the model. What lies in the core as a core unit for modeling randomness? This is the core unit. Because on top of this, everything is about how much drift you want, how much sigma you want, correct? This is the core engine for modeling randomness. Okay, so we will take that x 0.5, 0.5 square root of delta t. This is going to be our engine for modeling randomness. If you want drift, you can adjust it here. If you want different variance, you can scale this guy. And if you want risk-free growth rate, you tweak these probabilities. Okay, so that can be done, but this is our core entity for modeling randomness. And we know that this process will take us, after a time, it will take us to what distribution? This is the distribution. Okay, so something that has mean 0, because drift and all you can add later, so then it will not be 0. And variance that scales with time. Let's see one quick visual. No, before that, we have done everything in discrete. So we are taking one step, adding lots and lots of steps together, and we are approximating a normal distribution. Now we are going to continuous. We can increase the number of steps so much it will look continuous. That's fine, but it's not truly continuous because it is still discrete. We are adding discrete steps. If we want something truly continuous that actually can take not just 2 values in one step in any small time interval, it should be able to take any kinds of states. Within time delta t, I can achieve only 2 states. This is in discrete. In continuous world, within the same small time delta t, I don't need 0.5 and 0.5. I need to have a distribution. You see, if you specify a distribution, then everything is possible. Distribution as in continuous distribution, not discrete distribution. What kind of distribution I can have in this small time so that this will lead to me exactly this in the aggregate. I know I want this as the aggregate distribution, but in the small time step also, I need to use something continuous, not these 2 steps. This is also limited to me. Okay, so what can I use here as a continuous distribution so that over time, the aggregate distribution is this? What continuous distribution I'll use in the small time? Continuous discrete. Any ideas? Exactly. So we know that when we add normal distributions, the resultant is a normal distribution. Means get added, variance gets added. We know this, right? We did this in moment generating functions. So we can have a normal distribution, a tiny normal distribution, mean 0, variance. Any ideas? What should be the variance? What should be the variance? variance should not be 1. Again, you are committing the same mistake. So if you take variance 1, then over infinitely many steps, you'll have infinite variance. Our variance is limited to t. We are talking about a small time interval delta t. Over time, variances will get added. What gets added to become capital T? Delta T, exactly. So now we are talking. Let me write dt because it's continuous, correct? So this is our process. I don't have to work with discrete up move, down move, middle move, left move, right move. We don't need all those. Simple, a random draw from a continuous distribution with a very tiny variance. Over time, when you keep adding these random draws together, that will result in this distribution. Okay, mean will remain as 0 and variance will just scale. dt, dt, dt. If you add a lot of dt's, it will become t, correct? And this is nothing but Brownian motion, rather standard Brownian motion. Standard Brownian motion, or SBM, which will be our core engine for continuous models. In continuous models, we'll not talk about discrete steps. Although in simulation, yes, we'll discretize because you cannot, in any simulation exercise, you have to break it down into tiny, tiny, tiny steps. That is all fine. But at least the model will become continuous. And this would be the core ingredient, Brownian motion, that will be used for continuous models. You will find this dbt. So let me call it Brownian motion. So this is Brownian motion, right? So dbt is normally distributed with mean 0, variance dt. Okay, and if you stitch it together, it becomes bt, Brownian motion, that is normally distributed with mean 0, variance t. And this dbt term would be is the core component of stochastic calculus in continuous settings. So we will look at the calculus involving dbt. All right, before we pause for a break, I just want to show you a quick animation. A lot of maths. So this is the scale symmetric random walk, because the up move and down move have been scaled, right, to keep the variance finite. T is 1 I've taken, number of steps is 10, so I've broken down the time interval from 0 to 1 to 10 steps. So each time step is 0.1, correct? And here are the 10 steps. Excuse me. And I'm keeping a track of sum of x. This is a running sum, okay? And x is easy, just 0.5 chances of up move, down move. You know delta t is 0.1, so you can calculate x in each of the random draws and you can keep a running sum. That is sum of x. So the blue line is what you see is the sum of x. All right. Now, if we increase n sufficiently, then it should approach a normal distribution. So there are 100 steps now. You see dt is now small, so it has been scaled down. Step size has been scaled down. Now, if I press F9, it will generate new paths. Okay. And the orange density that you're seeing is the terminal density of the process at t equal to 1. Okay. It's clear? The highest density is at 0, obviously, because that's the mean. Overall, the process has a mean of 0. So normal. And then if I increase t, the one thing I wanted to show you is that the variance scales with time. So if I increase t, the variance is higher. You see higher dispersion. Here you see a concentrated distribution, right? Here you see a higher variance or higher dispersion. But mean is 0. Variance is now t, or variance is 2 right now. Okay. And if you make number of steps even higher, this will look like a Brownian motion. It will look like a Brownian motion. But in reality, the Brownian motion will be draws from normal distribution, not this. So in discrete world, the scale symmetric random walk is the equivalent of Brownian motion in continuous world. Okay, because aggregate overall, their effect is the same. In the long run, the outcome of this particular random walk is a normal distribution with mean zero variance capital T, and the outcome of a Brownian motion also over long run is the same distribution, normal distribution with mean zero variance T. So this is how we can establish the connection between discrete to continuous. All right. Okay, so if there is no questions, let's pause for 5 minutes, and then we'll do deep dive into stochastic calculus. Not deep dive, it will be introductory. There will be some stuff that will be covered in the next class, but we'll have a very good amount of material today to keep you thinking and wondering. This is really bizarre. Whatever calculus we know so far will be completely thrown out of the book. This is a new branch of calculus that you will see. All right, let's see meet after 5 minutes. If there are any questions, you can ask me. I'm here. Okay, let's resume. So we ended at this result. So in discrete, we will never talk about discrete anymore after today's class. Um, so x becomes dbt, which is normally distributed, and sum of x is like your aggregate Brownian motion, 0, small t, because this is small t I'm taking, okay? All right. Now the trick is, whenever we'll look into we'll go into calculus for Brownian motion. So ordinary rules of calculus do not apply as it is. It needs a separate treatment because we are dealing with random quantities. It's a random draw. BT is a random quantity. In ordinary calculus, there is nothing that was random. If you have f of x equal to, let's say, log x, if you know x 0.5, you know exactly what log x is. All right. But here, if you know time, so Brownian motion is a function of time, not explicitly a function of time. Its variance is t, so it depends on time, yes. But is it fixed? It's not fixed. It's a random quantity. So the rules of calculus will be completely different. We'll go there. All right. What is helpful always is to remember this picture. Is that suppose you are trying to model something from between 0 to t, at different points we are doing random draws from this normal distribution. These are dbt, which is a random draw from this normal distribution at different points. Okay, so here it might be here, at this point here it might be here, it could be here it could be at 0. Okay, it's a random draw from a normal distribution. This is the distribution. Okay. And we can see one small integration. This is very straightforward. So if we integrate dbt, what does it mean from 0 to t, for example? If we can, so integration means always you have to think integration in terms of sum. In case of stochastic calculus, you'd always have to think integration as a sum. You're just adding a bunch of random quantities. Okay. So this is, and we know this is correct. This is the aggregate effect. If you add lot of normal variates with variance dt, then over time all those small normal variates gets added, and the overall effect is another normal distribution with the same mean 0, because you are adding all the means were 0, but the variance gets added. So if you keep adding dt from 0 to t, if you add dt, sum of dt is t. So that is what the variance is. First time in life, we are seeing that integration is a random quantity. This is a definite integral 0 to t, but the output is a random quantity. Okay. All right. So that is the first surprise. Again, let's talk about the properties of Brownian motion. Properties of Brownian motion. First, we assume always that b0 equal to 0. At time t equal to 0, the value of the Brownian motion is 0. Okay, we don't know what is, wherever you start the counter at t equal to 0, at that point, since we have no information of the Brownian motion, we replace it with the average value. That is the convention. Okay, assume it is 0 at t equal to 0. This is the definition or the property, you can say. It is always assumed to be 0 at t equal to 0. Second, bt minus bs. So this is I'm talking about two different points in time. Let's say between 0 and capital T, I have two time points. One is at S, one is at T. My Brownian motion would be, so what is Brownian motion? It is collection of small normal distributions. Okay, I keep adding them together. So random draw here, random draw here, random draw here, you keep adding them. So probably you'll see something like this. And then from here it can go to anywhere. It's just going in its own flow. All right. At each point, at each time point in that tiny interval, it's a random draw from this distribution. Always keep this in mind. A random draw from this distribution, and you add it to the Brownian motion, what it was before, and you just keep adding these normal variates. So bt minus bs is what? Brownian motion here minus Brownian motion here. That's called the increment. This increment is independent between intervals. Independent, which means what was the increment between 0 to s? That is bs minus b0. What is the increment between 0 to any other time? Maybe r something here. So br minus b0. All these increments, this increment is completely independent of this increment, and this increment is completely independent of these previous two increments. Okay, as long as you have an exclusive time interval, what happens in one particular time interval is completely independent of what happens in other time interval. And at the back of your head, think of these independent x that we are doing in discrete, correct? These were all independent, right? So from step 0 to step 25, how much of x you added? This whole thing is independent from 26 to 50, correct? Sum of x. This thing is totally independent of this. This does not depend on this. Everything was independent. So here, since we're talking about continuous time models, as long as the time intervals are not overlapping, that means these steps are not mixed up, they're completely separate, then the increments are independent of each other. Okay, it's a restatement of the same thing that we had in case of discrete. All right, if this is independent, then this is independent. Okay, and the what is the distribution of the increment? What is the distribution of the increment? T minus S. All right. Because you see between BT and BS, the Brownian motion on an average is just adding up normal distributions, bunch of normal distributions together. Every single normal distribution has a mean of 0. All right. So from here to here, you will be adding small normal distributions, random numbers drawn from these small normal distributions. All are independent, identical. Correct? All are having the same distribution. This is the distribution, and they are independent. Time intervals are not overlapping. Okay. Once you keep adding these, you'll always end up with a zero mean and a variance, which is the time difference. It's straightforward, correct? From here to here, what is the time difference? T minus S. So this increment will have a normal distribution, mean 0, and variance is the time lag between these two. Okay. So property is Brownian motion increments are independent and identical, and this is the distribution. Okay. Another term is called stationary. If you have studied time series, you know what stationary means. So stationary would mean, so Brownian motion increments are also stationary, meaning it's very easy. So from 0 to capital T, if you take an interval here, which is having a length of, let's say, delta T. If you take an interval here, same interval, delta T, width is same, then they have both of these increments have the same distribution. 0 delta T. Okay. Stationary means this. It does not depend on where you are looking at, I mean, at what time point you are looking at. The variance of the distribution is only dependent on the time lag. It is not dependent on where you are looking at. As long as the time lag is same, the variance will be same. Hence, it is stationary. Stationary, okay? Constant variance you can think of. As long as the time lag is same, the variance should be same. Doesn't matter where it is situated. That is stationary. Okay. All right. Any questions? Properties are understood. This is the picture that will help you to always connect. All right. Any questions, or is it clear? Am I audible, guys? Okay. All right. Let's move on. So we said that the standard Brownian motion is this. With the property and the aggregate is this, with the property that B0 equal to 0. This is also called as Wiener process. You'll see DWT sometimes. Same. Okay. Just different notation and different name. How is this connected to standard normal? Connection to standard normal. Standard normal has is normally distributed with mean 0, variance 1. Okay. So if that's the case, then how is DBT related to standard normal? How can I write this? dBt is equal to, please help me write this in terms of Z. dBt is something times Z. Z into delta T is not correct. You are close. This is not standard deviation, this is variance. Okay. Z into square root of dt. So that variance of dB would be dt, square root dt is a scalar. Whenever you calculate the variance of something, you take the square of the scalar, so it becomes dt times variance of z, dt times 1 dt, which is what we want. All right. The other way of looking at it is, remember when we use x is equal to mu plus sigma z transformation, correct? Here there is no mu, it's all zero, everywhere it is zero. So x equal to sigma times z. But what is sigma in our case? What is the sigma of x? Square root of dt. So dbt is equal to square root of dt times z. Okay. All right. Some more properties. Rescaling property. It's pretty interesting. This quantity, what is the mean of this? So basically what I'm doing here is CT, C is a scalar. So you're looking at a Brownian motion at 5 times t, okay? What would be the property? We know, okay, we know this. If this is true, then what is BC times t? BC times t would be normally distributed with mean 0 and variance. What will be the variance? Variance is CT. Yes, because this becomes your new t. Or agree? So what will be the distribution of this quantity? Normal distribution. Scalar will not affect the mean. So 0, comma. When you are taking variance, is always the square of the scalar that will enter. So 1 by c times ct. That is equal to normal distribution 0 t. This is another SBM, standard Brownian motion. Okay. Rescaling property. And whenever we use the word standard, that always means it is free from parameters. There are no mu or sigma or anything. It's standard. Standard normal has no parameters. 0, 1. There is no mu or sigma or anything anywhere. So it is standard. Standard Brownian motion has no, so not this one. Standard Brownian motion has no parameters. Does it have mu, sigma or anything? No. Hence it is called standard Brownian motion. Okay. And so let me also tell you this. So if you want something to have this kind of a distribution, then what will you do? You will just use this. Okay. So this will have this distribution. Then this is not standard Brownian motion anymore, because its variance is not t, it is something else. Okay, so this part is the standard Brownian motion scaled by sigma. Will have this variance. Okay. Another property, time inversion. T times B 1 by T. What is the distribution? Mean will be 0. Variance would be T square times Brownian motion with any time interval will have the same variance. Standard Brownian motion. Okay. Now probably the biggest surprise. Brownian motion is not differentiable. dB by dt is meaningless. dB by dt is meaningless. What? How is that possible? So we know something is non-differentiable when. So what are the reasons that we know if that can cause non-differentiability? One reason is if it is not continuous. If the function itself does not exist at that point, right, then it will not be differentiable. At this point, there is no derivative. The other reason that we know from ordinary calculus is if it has sharp points. Sharp points, example, mod x. This is the plot of mod x. It is, although it is continuous everywhere, it's defined everywhere. There is no point where it is not defined. It's defined everywhere, but at this point there is no slope. Or you can think there are two different slopes. Little bit to the right hand side, it has a slope of +1. Little bit to the left hand side, it has slope -1. At x equal to 0, slope is not defined. So this is the feature of a function that has sharp points, right? So slope is not defined at x equal to 0. Brownian motion, is it not continuous? It is continuous. It is everywhere. Does it have sharp points? Not really. Why is it not differentiable? It's a whole new different types of reason. The reason is this is way too squiggly or jagged. These are the words used. So for differentiability, basically you're trying to find out the slope. All right. At a given, so if this is a smooth function, at this point the slope exists, because if you zoom it sufficiently at this point, this thing looks like a line. Zoom it at this point, if you zoom it significantly, it will look like a line, and the slope of the line becomes the slope of the curve at that point. That is the whole idea, right? It approaches a line segment. Brownian motion is so squiggly. If you try to find out the slope of the Brownian motion at a given point, if you keep zooming the Brownian motion more and more and more, it never becomes a line. It will look exactly how it looks like. Doesn't matter how much you zoom, you keep zooming, it will look exactly the same, squiggly. It never becomes smooth. So slope is not defined. Let's see an animation. Okay. So here I have the plot of sine x or sine t rather versus Brownian motion. In x-axis I have t. Okay. The blue curve is that of sine x or sine t, and the orange one is the Brownian motion. Brownian motion is simply random draw from the normal distributions, okay? And I have joined them together. If I zoom this, I'll keep zooming, okay? um, Excel is slow. So you see sine t will start looking like a line. But look at the Brownian motion. So I'm looking at a time interval which is very close to the origin from 0 to 0.5. Within that interval, sine x is almost like a line. But look at the Brownian motion. It is exactly how it appeared before, right? It is too much squiggly. That is why it is non-differentiable. All right. Uh, yeah. Okay. Any questions on this? Probably this is the biggest surprise or probably unique feature about Brownian motion. Non-differentiable, continuous everywhere, differentiable nowhere. Remember this. Continuous everywhere, differentiable nowhere. All right. Now let's look at a few other items, and then we will be in a good spot to close the session. um, One moment. Okay, so in ordinary calculus, right, um, when we calculated the, how do you calculate change in a function? Delta f, suppose. Using Taylor series, delta f by delta x, let's say f is a function of x. Dx plus half delta, the second derivative, times dx square. Oh, let me not write d here because I'm taking delta. So let me write delta everywhere. Okay, and other terms you can ignore for now. So this is Taylor series expansion. Taylor. When delta x is sufficiently small, then I can replace delta with d. Since this is one variable, I'm using df by dx. If f was a multivariate function, I will use partial derivative. But for now, this is ordinary derivative. Dx, correct? Plus half d square f by dx square times dx whole square. Since delta x tends to 0, dx is infinitesimal. So this term always got ignored. If you make delta x sufficiently small, then you do not have to worry about this term because dx square would be very, 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 very small compared to this term. So this term will dominate, this will be insignificant. That is why we always ignore this term in ordinary calculus. And you see this also matches, right? So df by dx equal to df by dx. Take this under this. We never had to worry about this, all right? When the changes are not small, then we used to use the second term to capture the change a little bit properly. But if it is differential calculus, where the change is infinitesimal, right? Then the second term never came into picture. All right. What happens in case of Brownian motion? Something very fundamentally different. Let's see. Let's see. So Brownian motion is a function of time. So when we are when we will deal with lot of In fact, let me take an example. Suppose we have a function which is a function of Brownian motion. That means it could be, let's say, for example, 3 times bt. Okay. My function is, I can write here 3bt, for example. This is a function of Brownian motion. Okay. Now, one thing that we said, that this quantity is meaningless. Meaningless. But that does not mean this quantity is meaningless. This is the differential. This is just the increment, small increment, differential. It is random, right? It is a differential, but this has meaning. Derivative with respect to time, which is the slope or derivative, that is meaningless. Okay. So in the world of stochastic calculus or Brownian motion calculus or Ito calculus, it's all the same. Ito calculus. We will work with differentials like this, not derivatives. We will work with differentials. All right, so let's find out the differential of this function df. Okay, what will be df? Df will be, use Taylor series. Partial derivative, so this is just bt. Okay, so just bt. All right. Derivative of f with respect to bt times dbt plus half times second derivative with respect to bt times dbt square. Okay. Other terms we can forget about. Now you see, so this is, in fact, I can calculate this. So second derivative is going away. Can we do something? Okay, let's take bt square. A little more fun. Bt square, okay, not 3bt. So derivative with respect to bt would be what? 2bt dbt plus half second derivative would be 2, because derivative of 2bt with respect to bt is 2 times dbt square. You can ask me, why am I keeping the second term? Let's see why. You see, this, the order of this term dbt is, it is z dt square root, where z is normal, standard normal. Okay. Although the average value, so the average value of this quantity is 0, because the average value of the random quantities, which is z, is 0. Dt is a deterministic term, small time interval. But the order of this term is square root of dt. Okay, if dt is like 0.00000, let me not write 00, 10 to the power minus 20, then square root of dt would be 10 to the power minus 10. Okay, so this is very significant. I am constructing this equation to measure changes in the time interval dt. Everything I'm checking what happens in the time interval dt. Okay, Brownian motion changes by dbt, function changes by df. What is changing? How much everything is changing in the time interval dt? The first term, so this, forget about 2bt. This dbt has an order of square root of dt. All right. Square root of dt is super significant in the time interval dt. This is so big. Okay. This is big, much bigger than this. So can I ignore this term? Of course not. I'll keep. So I'll keep this term. Keep. Typically in ordinary calculus, we ignore the second order terms. But here, let's see what happens. What is dbt square? Z square root of dt whole square, correct? Which is z square dt. Z square dt. So this is the order of this quantity is at par with dt. So I cannot ignore this term. This term will remain. Even if it is square, a square of a very a random quantity, and it's coming out that the order of this square term is in dt. And I'm talking about changes at the dt level, and this change would be significant. So I cannot ignore this. So in stochastic calculus, the key change or key difference between ordinary calculus and stochastic calculus is this higher powers, especially this term dbt square. This is the culprit. Okay, you cannot ignore this term. Now, this term is actually, if you simplify, it becomes much more simple, and it is very surprising. So let's look at this particular quantity a little bit in depth. So we said that dbt square cannot be ignored because the order is dt. That's fine. And this is nothing but z square dt. Okay. It is random. Yes, looks random because it's z square. Z is a random quantity, standard normal. If it is random, what is the expectation and variance? Let's see. Expectation of dbt square is expectation of z square dt. Dt is constant, deterministic, it will come out. It's not random. Dt will come out. Expectation of z square. This is how much? What is expectation of z square? Be careful, it is not z, it is z square. It is 1. Because expectation of z square is the variance of z in because it's standard normal, right? So this is 1. dt is the expectation of this quantity. All right, what about variance? Scalar will come out as square because variance of something, this is a scalar, scalar will come out as square, variance of z square. What is the variance of z square? This might be difficult, but do you remember what is the distribution that z square follows? If z is standard normal, what is the distribution of z square? Chi square with degree of freedom 1, correct? Chi square with degree of freedom 1. And chi square distribution has a mean of, so chi square distribution of degree of freedom will have a mean of 1 and variance of 2. Okay, this is the property of chi square. If you look at Wikipedia, you can see the result. If we are adding bunch of zk square, then this is chi square with degree of freedom k, and that will have a mean of k and variance of 2k sigma square. This is the property. Since we have only one standard normal, the variance would be 2. So this is 2, but now this is interesting. What is dt whole square? dt is very small, and we are talking about dt square. Dt square is negligible, 0. Okay, dt square definitely can be ignored. This is 0. In limiting terms, when dt tends to 0, the variance of this random square of this standard Brownian motion is 0. What happened here? So are you saying that this quantity has a mean of dt and variance of 0? Anything that has a 0 variance is deterministic. So this is not random. This is not random. Surprising, isn't it? dbt is random. Square of dbt is deterministic. This is true because it is so small, the variance is so small, as if there is, it only behaves as if the mean is there, dt. There is no variance. The value of this is almost non-random in limiting sense. Talk about a very tiny small time interval, you can almost always expect that dbt square in that small time interval will be same as the time interval. It is not, it is non-random. All right, 0 variance. That is very interesting. So this is the key result that we'll use everywhere. So going back, in this particular development, we can write this as, so let me take it here again. F is bt square, and we derived df is 2bt dbt plus half times 2 will get cancelled, so dbt whole square. Now dbt whole square we know is dt, so just dt. I can change this f to write d of bt square, right? df is d of bt square. Okay, so this is called a you can call this as SDE, stochastic differential equation. We had ordinary differential equation, ODE. Then we had partial differential equation, PDE, where D got replaced by del. This is ODE world. This is PDE world. Now we are talking about a separate branch of calculus, stochastic differential equation, SDE. And all SDEs have this guy. This is the hero. Something that is random. A differential of some quantity, change in some quantity that has some randomness to it. Hence it is stochastic differential equation. Never you will see an equation which is dv by dt, or we do not write derivatives in the equation. It is always differential. In ordinary calculus, in partial differential equations, you can always write partial derivatives, ordinary derivatives. But in a stochastic differential equation, you will always see differentials in this form. All right. And so this is dt, the coefficient here is 1. That is the deterministic growth. So this is talking about a change, right? That change is nothing but there is a deterministic component that just grows with time. So if you give me a time interval of 0 to 5, this particular quantity will become 5. After you get an SDE, this is stochastic differential equation, you should you have to integrate this to get the solution. Exactly how we used to go from ODEs to solution, remember, by integration, or PDEs to solution. Similarly, from SDEs to, we'll get the solution. Solution would be like, what is this BT square in closed form? That would be the solution. Okay. So, actually, there are a lot of other, development that we have to complete. So, entire Ito calculus branch. I think let's not go there today. We had too much. We will again come back to this. I will start with this, whatever brief introduction we did for stochastic calculus. We'll start with that. We'll look at some more examples, and then we'll derive the stock price stochastic differential equation, which is the GBM, geometric Brownian motion. So we'll derive that next class. And we'll look at some more theorems and properties of Ito calculus. And there is you must have heard it, or Ito or Ito, whatever, Ito's lemma, which is famous. It's there in every book. You do not have to remember Ito's lemma at all, because there are 3 different types of variations suited to different types of situations, 3 different versions of Ito's lemma. You don't have to remember that at all. As long as you remember Taylor series expansion properly, that will be sufficient. It's just a couple of steps, and you have to. So every time we have to replace this quantity with dt. Okay, and just do a Taylor series expansion. So we'll see there. Let's not do it today. We'll see that. As long as you're comfortable with Taylor series expansion, there is nothing so much difficult about it. You do not have to remember Ito's lemma. It's a consequence of Taylor series expansion. So yeah, let's look at stochastic calculus in great detail in the next class. I am pretty sure you had a lot of surprises today. So between today and next class, spend some time thinking about it. So we'll be ready for the next class. All right, let's close here. Thank you so much for your patience. I hope you found it useful. Mihir has a question how this can be used in trading. So this is the bread and butter of trading. You have to create. So you see, what is the trading mechanism? There is a mod. So since you asked the question, right? Market model. Market will price a security through demand and supply. You will price the same security through model. Stock price, interest rate, commodity, FX, credit spread. All these are risk factors. We will develop continuous models for all these risk factors. For stock price, we have GBM, geometric Brownian motion, which we'll see in the next class. People have added more complexity to it by adding, let's say, jump diffusion. There are other models also, variance gamma model. Interest rate, this is a whole. So, okay, before that, stock price, commodity, and FX. All of these belong to the same asset, model class. If you can model stock price as geometric Brownian motion, you can also model commodity prices and FX as geometric Brownian motion. Reason being, there is no upper limit for all these. Stock price can go up to any extent, commodity price can go up to any extent, FX rate can also ideally go up to any extent. There is no limit, correct? So all those models we'll learn, all right? And then when we are done with equity, we will go to interest rate class. Now, interest rate class has a whole different type of model class. You know, Glassy check, Cox, Ingersoll, Ross. Then there is a lot of HJM framework, Hull and White. We'll look at all these models. Only BDT, okay. LIBOR market model. LIBOR is gone, but I mean the idea is important. So this is a big topic, huge topic. After you have identified the models, every single model will have this term. Okay, I'm just giving you a heads up. Every single model will have this because they're random, right? All these are random processes. So in order to model randomness, we need some random quantity in the model. This is the core unit for modeling randomness. After you have developed your model, you give it to the calibration team. They calibrate the model with respect to historical data so that you can calibrate your parameters, mu, sigma, for interest rate, maybe mean reversion parameter, k, long run average, all those you can calibrate. After you have calibrated, then again, you have to go to risk neutral density to come up with price of a derivative, which is a function of all these risk factors. So you can create thousands of different derivatives within equity class also. How many different derivatives there are? American option, European option, Asian option, barrier option, knockout, knock-in option, passport option, look back option. I can go on, right? Similarly, for interest rate class, you have thousand other types of derivatives. So from this model and calibration and risk neutral density and Martingale and all that, you will come up with the price of the derivative. So when we started with model price, this is what is the model price. Then you will check the model price with the market price. Is it undervalued? Is the market price undervalued? Then buy. If it is overvalued, sell. And whole thing you can automate. Algo trading, what does algo trading do? This is what algo trading does. There is a model price and you compare it with market price. And based on that, you take a decision. All right. So that's one way to go about it. The whole other use case is risk management. So this is from pricing and trading perspective. And the other side is risk management, where we are going to calculate VAR or expected shortfall for that matter. But again, those will be from these models. So we'll get there. Does that answer your question? Did you get some context where we are heading with this course? All right. Any further questions? Okay. We're good. So see you in the next class. I don't know when it will be. I'll announce beforehand. All right. So what will be, so next class will cover stochastic calculus in detail. Okay. We'll look at a couple of examples. We'll derive the GBM. So that will be the agenda for next class. All right. Thank you so much. See you.